Hi, my name is Shilpa Vikram Jain and this is Market Brew. Here we make markets simple, one sip at a time. Every morning, traders in India wake up and check SGX Nifty, Dow Jones or crude oil even before checking Sensex or Nifty. Ever wondered what is it that these experienced traders are looking for and how are these global events happening thousands of miles away affecting our markets? Well, today I'm going to share top 5 global events that can move and shake Indian stock market. Stay tuned. Number 1, US Federal Reserve's decision. Now, US Fed is the most powerful central bank in the world. If US decides to hike interest rate, cost of borrowing dollar increases the world over. Your FIIs, hedge funds who borrow money from US and put it in emerging markets will start to see profitability pressure because cost of borrowing increases for them. At the same time, they will see better, more lucrative returns back home which are less risky. So they start to pull money out from emerging markets and park it in US bonds. I remember in 2022 when Fed was aggressively hiking interest rates because of COVID and money printing, rupee had seen a record low and Nifty had corrected nearly 15%. So yes, Fed's speech can move and shake our portfolio, sometimes even more than our finance minister's budget speech. Watch out. Number 2, US inflation and jobs data. Now, US market lives and dies by data. Every month, US announces inflation and jobs data which decides Fed's next move. Higher the inflation means higher the chances of rate hikes, which usually puts a pressure on Indian markets, like we discussed in point number 1. Similarly, let's say US releases a weak jobs data. That signals like a slowdown in US economy, which is a bad thing for our export-oriented companies like our IT sector. Your TCS and Infosys will start to see a pressure. So you see, even if we are trading in Indian stock market in particular stocks, we need to be mindful of inflation or jobs data number, which are like the weather forecasts for us. Number 3, China's economic policy and stimulus. Enough of US, let's move to China. Now, China is the world's factory, as you know of it, and it is the biggest consumer of commodities. So if there is a slowdown in Chinese economy, that means less demand for commodities like oil, minerals, metals, fertilizers, chemicals, which is not a good thing for our export-oriented companies like Tata Steel, but is a good thing for sectors like auto, infrastructure, because cost of input decreases for them. Similarly, let's say if Beijing decides to provide a stimulus, that means there will be a spike in commodity demand, which will trigger an inflation the world over, including India. Our RBI will be forced to stay hawkish because of higher inflationary pressure. But it's not all bad news, because when Chinese economy shows a growth, FIIs start to see Asian market as a whole. So the money flowing into emerging markets will also flow to India. So you see how different parameters and factors happening far in China are affecting our sectors, our specific stocks, and even at the macro level. An interesting saying, if China sneezes, the whole world market catches a cold. Number 4, crude oil prices. Now, India imports 85% of its crude oil. So if crude oil prices increases, that swells our import bill. For the same amount of oil, we'll have to shell out more dollars. Demand for dollars increases, puts pressure on rupee, and inflation increases. So you see how crude oil prices not only affect the oil dependent sectors like your aviation or paint industry, but also affect the overall macro structure of our markets. At the same time, if crude oil prices decreases, that improves our current account deficit, rupee stabilizes, we as consumers, we have more buying power. So sectors like your FMCG, consumer products, they see an uptick. So that's why the experienced traders, they see Brent crude first thing in the morning before deciding their strategy of the day. Number 5, geopolitical tensions. Now that's the biggest wild card. Wars, sanctions, trade disputes, tariffs, all of these can shock our markets overnight. Take Russia-Ukraine war for example. The crude and fertilizers prices went soaring high, hitting Indian inflation really hard. These geopolitical tensions create a lot of uncertainty, and traders don't like uncertainty. Market either goes up or down. No room for uncertainty. So the traders start to move money from risky markets like India and put it in the safe havens like gold or US bonds. Alright, so those were the top 5 global factors which can sway or shiver the Indian stock markets. I'll be going deeper into each of these factors for a better understanding. So don't miss out to watch out the series. So that was today's market brew. Sip on it, stay curious, and don't forget to subscribe for your next cup. Till then, bye.